Everyone, and thank you for joining the Market and Economic Update. This evening, I'll be bringing you through the first quarter of the market. I bring us up to speed all the way until today, April 26th, with returns and that type of thing. We'll go through what the economy looks like, where we see things going, and I think this will be very educational. So sit back, relax, and let's jump into it. What I need to do is I need to start with some important disclosures. Triumph Capital Management is a registered investment advisor to the SEC. Inside of tonight's presentation, I'll be making some forward-looking statements. Of course, as Yogi Berra says, making predictions, it can be difficult, especially about the future. All joking aside, any forward-looking projections that are made are just that. They're forward-looking types of projections. In addition, I'll be showing you some historical returns, and the historical returns are no indication of future returns. So let's jump into it. For those of you in tonight's presentation who don't know me, my name is Derek Eichenwald. I have the distinct pleasure of serving as the CEO of Triumph Capital Management. Again, we're a registered investment advisory firm. Our home office is located in Denver, Colorado. We have offices up and down the Front Range, as well as in California, Nevada, and so on and so forth. Let's start with a quick 2022 review of the markets. As most of you would remember, last year was a dismal year for the market. The NASDAQ was down a whopping 33%. The Russell was down a whopping 21%, and the S&P 500 lost 20%. As we move forward, 5 short months later, what do we look like today? So if we look at those same indexes, the NASDAQ, as of the close of business today, up 17%. The Russell, as of the close of business today, up about 1.3%, and the S&P 500 up about 5.6%. Just as a quick review, the S&P 500, people think, what the S&P 500 is it's 500 of America's largest companies. Folks often believe that the index is perfectly weighted. However, it's not. As you can see here, technology represents the largest weighting of the S&P 500 at 25%. And when I ask people, hey, can you name some companies inside of the technology sector? People often will say to me, yeah, I can. Apple, Microsoft, Facebook, Google, so on and so forth. Well, what I will tell you is technology companies, if they answered the question that way, they would be correct. Apple and Microsoft are technology companies. But a lot of companies that people associate as tech fall into the communication services sector. Companies that live in that communication sector are companies like Facebook, companies like Google, companies like Netflix. Interestingly enough, we think of those areas as tech, but if you add technology and communication services together, it represents nearly 33% of the entire S&P 500. So you can see those different weights. By the way, if I break down the returns through 2022 by sector, you can see technology was down 28%. You can see that consumer discretionary, those are companies that live in the world of what we do with our discretionary dollars, such as Amazon, so on and so forth. And communication services like a Netflix, like a Google, like a Facebook, down close to 40%. I highlight those here. Those were the worst performing areas of the market. If we look at the market's biggest companies out there, they had a dismal year in 2022. Apple was down a whopping 28%. Microsoft was down 29%. Facebook down 66%, and Google down 40%. Now, one thing that does happen is that the S&P 500 gets rebalanced quarterly. It happens on the 3rd Friday in March, June, September, and December. Therefore, the last rebalancing was on March 17th of 2023. And what you can see on your screen is you'll notice, look, at the end of 2022, tech represented 25.7%. At the end of March, okay, right after the rebalance, you can see what these different weights inside of the S&P 500 became. We'll have, our next rebalancing on the 3rd Friday of June. And as I mentioned earlier, what a difference 5 months makes. If you remember, Apple down 28%, NASDAQ down 29%, Facebook down 66%. If we just move forward, Apple year to date at the close of business today, up 26% for the year. Microsoft up 23% for the year. Google, which is, I'm not getting a graphic here, but as I mentioned in my last slide, Google was down 40% last year, up 17.5%. And Facebook has been performing wonderfully. Today was a wonderful day for Facebook. Facebook up 94.5% year to date. If I then draw your attention to the different sectors, you can see here, this was what they did in 2022. As I mentioned, technology was down 28, year to date up 17. In fact, if we focus in on those worst 3 performing sectors of the S&P 500 in 2022, you can see what they're up thus far in 2023. Sometimes those losers revolve. And that's exactly what we've noticed through 2023. The losers of last year have become the winners of today. Again, the S&P 500 up about 5.6% for the year. If we take a trip across seas and we go internationally, let's just remind everybody in the webinar this evening what the international markets did in 2022. Frontier countries. What in the world are frontier countries? Listen, I think before I explain frontier countries, I'll explain emerging markets. So we've been referring to emerging countries, emerging stock markets as emerging markets for years. And the question is, how long can they remain emerging? And so what's kind of come up is this new thing called frontier. Frontier countries include countries like Egypt, Pakistan, Morocco, the Philippines, Kazakhstan, Romania, so on and so forth. What's in the emerging market space is the stuff that you remember: India, Taiwan, Hong Kong, Brazil, Mexico. And of course, what's inside of developed Europe, the UK, Germany, Switzerland, Japan, Australia, so on and so forth. You can see that overseas, there was a dismal market through 2022. If I fast forward here to 2023 and show you how these different areas have performed as of the close of business today, you can see developed, international, again, that's UK, a lot of Europe, Japan, Australia, so on and so forth, up a nice 11%. Emerging markets, which again includes India, Taiwan, Hong Kong, Brazil, so on and so forth, up slightly with 1.3, and frontier down slightly for the year. Okay, so things have gotten a little brighter through 2003, since 2022. Let's flip for a second. Let's talk about the bond market. So the bond market, by the way, 2022 was the worst year for the stock and bond market. Hold on a second. What do I mean the worst year for the stock and bond market? Certainly, there's been years where the S&P 500's been down more than 20%. Without a doubt, there's been years that the S&P 500's been down more than 20%. What I mean by the worst year for the stock and bond market is you've never had a year with both markets being down as greatly as they were. If we look at the bond market, we can break down the bond market into different segments: investment grade bonds, US treasuries, treasury inflation protected securities, high yield or junk bonds, and municipal bonds. You can see what the rates of returns were for these different segments of the bond market. Quite interestingly, you will notice that investment grade bonds were the worst performing sector, down nearly 18%. I say that's interesting because what also exists in that segment, when corporations go to raise money, they issue bonds, are high yield bonds. Those are less creditworthiness companies. Well, look at what high yield bonds were down, only 11%. I say only 11%, but when compared to their counterparts of investment grade, investment grade bonds were down nearly 18%. A lot of you have seen a graph like this in previous presentations. I think we do have some new folks inside of the webinar tonight, so I will take a moment to show this. What you're looking at here is you're looking at the aggregate bond index. What the aggregate bond index does is it goes to take these various sectors of the bond market and it blends them together in what is referred to as the Bloomberg US Aggregate Bond Index. The chart here is simply showing the gray bars are any year that that bond market had a negative rate of return. And so you notice a lot of gray bars to the upside. You do see one or two or three gray bars to the downside. Now the red dots that you see are representing any year at one point during that year what the bond market was down. This is going back from 1976 until the end of 2022. The first thing that I want to draw your attention to is every single year since 1976, at one point during the year, the bond market was down. You can see what it was down at one point during the year, again reflected by the red dots. However, what the gray bar represents is what the bond market, the aggregate bond market, did come the entire calendar year. As you will notice, at one point last year, we were down 17% in the aggregate bond market. We ended up down 13% again. Bond market, it was the worst year, and as this graph depicts, you can see it goes all the way back to 1976. And I point that again last year. What 5 months make. So you can see no different than with the markets. You can see the bond markets are all inside of the black so far for this year. I'm showing you the returns as of the close of business today. And you can see what the returns were again through 2022. Investment grade bonds, which was the worst performing sector of the market, the best performing sector of the market as of the close of business today. So why was the bond market down so much? Well, as most of you know, there's an inverse relationship between bonds and their price. Let me explain. Let me give you a little history. When companies go out there and they go to raise money, instead of big, large publicly traded companies, governments, municipalities all do this. Instead of walking into a bank and looking for a loan, what they do is they go to the world and they say to the world, hey, we need to borrow money. And what they do is they hire an investment bank to say, hey, listen, how's our credit worthiness look? What do you think we need to pay in interest? And that investment bank looks through the books and comes up with something, hey, we think you need to pay 4% or 8% or 19% in interest if anyone's going to buy your bonds. Day one, the company goes out there and they sell their bonds for $1,000. And let's just pretend this is back before computers. So when I say back before computers, let's say you were the purchaser of a bond. Day one, you paid $1,000 for the bond. And a little bit of a history lesson, what came with that bond were these little perforated pieces of paper that lived on the outside of the bond. And the bond said, hey, listen, you're the proud owner of a bond from ABC Corporation. And in the upper right-hand corners, it said, this bond pays 5%. And so what you would do is every 6 months, you would walk down to the window and you'd pull one of those coupons off of your bond that you were keeping in your desk drawer. And what they did was they gave you $25. And so through the course of the year, you collected $50 or 5%. What that bond also said on is it said, hey, this bond matures, whatever, pick a date, April 15th of 2030. Well, you were taking off those little pieces of paper every 6 months from your bond. Your bond was sitting in your desk drawer, and sure enough, April 15th of 2030, you went down to that window, and what'd you have? You had your big bond, and it had one coupon still attached to it. You gave that to the nice person sitting behind the window, and what'd they do? They gave you back your $1,000 for your bond, and they give you your last $25 interest payment. Now, let's pretend you bought the bond for $1,000. It's sitting in your drawer. You're taking those $25 coupons off of it. Life is good. But 3 years have gone by and the bond doesn't mature until 10 years from now. And you say, hey, geez, I'd really like to sell this bond back. So you bring the bond back to the window and you say to the nice person sitting behind the window, hey, listen, I know I'm supposed to hold this for the next 7 years, but I really need my money back. And the person behind the window says, We don't do that. We don't redeem it. You know, we redeem it on the day of its maturity, but we don't redeem it prior to that. And so on your walk home, you stop by your neighbor's house and you say to your neighbor, you say, neighbor, listen, I have this great bond from the company down the street. And listen, Junior's going off to college. So you know, this bond's great. I paid $1,000 for it every 25, excuse me, every 6 months. You know, I get to collect $25. And but I need the cash. So will you buy it from me? And your neighbor says, hey, hold on a second, and goes into the kitchen and comes back out. And they say, you know what? I'll buy the bond from you, but I won't give you $1,000 for it. I will only give you $800 for it. And you say, neighbor, why would you do this to me? Junior's going off to school. I need the liquidity. You're going to get the $1,000 back, you know, in 7 years from now. Plus, you get to collect the $25, you know, every 6 months. And your neighbor says, listen, I can go down to the same company today, and instead of buying a bond that only pays 5%, I can buy a bond because interest rates have gone up, let's just say. I can buy a bond that pays 7%. So I'm not going to pay $1,000 for your bond that only pays 5%. And so one of the reasons why the bond market was down so much, its worst year in history, was because of what's gone on with the federal funds rate. As most of you know, March 3rd of 2020, the federal funds rate was at 1.25. This is as coronavirus was first kind of coming into the US. Well, 12 short days later, on March 15th of 2020, the Federal Reserve made an emergency cut, and they cut by 1%, bringing the federal funds rate down to 0.25. The federal funds rate, by the way, is the rate that the central bank, the Federal Reserve, lends money to its member banks, let's say like a Wells Fargo. Wells Fargo then turns around and lends it to you, and Wells Fargo makes the spread. If they're borrowing money at 0.25 and lending it to you at 3%, Wells Fargo is therefore making the 2.75 basis points in spread. Why did the Fed cut rates like this? Okay, people might say, hey, because of coronavirus. Well, think about it. It spurs economic activity. When this happened, everybody went to go refinance. Everybody's credit card rate went down because those are variable rates. And by the way, the Fed held that rate at 0.25 until March 16th of 2022, literally 2 full years. On March 16th of 2022, okay, which was just basically a year ago, the Fed made its first increase in the federal funds rate and brought the federal funds rate to 50 basis points, as you can see on my screen. However, over the course of 2022, the Federal Reserve raised rates at every single meeting, essentially, and brought the federal funds rate all the way up to 4.5%, an 800% increase through 2022. By the way, the Fed has had their 2 meetings thus far in 2023. And today, the federal funds rate, the Fed has continued to increase. Today, the federal funds rate is at 5%. Now, May 3rd, the Federal Reserve has their 2-day meeting ending, and they will announce what they plan to do with interest rates. Right now, the forecast is that they will raise by 25 basis points, bringing that federal funds rate up to 5.25. But at the same time, the market, one of the reasons why the market's somewhat been behaving nicely is I think the Fed will give some guidance such as, hey, we are not going to be raising rates moving forward. Now, of course, the Fed's not going to say it that way. They'll say something like, we're going to be data dependent. If we see inflation, of course, we'll be inside of there. One thing that I'll say that most of you inside of the webinar have heard me say in the past, the Federal Reserve has a mandate. It's called the dual mandate. The dual mandate is that they have unemployment at 4% and inflation at 2%. What I will tell you is both unemployment and inflation are well above their targets. In order to get to their targets, they continue to raise the federal funds rate to cool down the economy. We'll unpack that a little bit more. Let's keep working here. Let me give you some quick market perspective. No different than what we saw with the bond market graph earlier. This is a graph of the S&P 500. This goes back to 1980. The red dots again show you in any particular year what the S&P 500 was down at its lowest point for that year. Well, the gray bars represent what the S&P 500 produced as far as rate of return in that year. In other words, so it's easy on the eye, in 1980, at one point we were down 17%. However, in 1980, we finished with the S&P up 26%. As you can see, in 2022, at one point we were down 25% for the year. But as I mentioned earlier, we ended the year down 19%. What I will say is markets don't stay down for long. In fact, there's not many years that you have consecutive down years. Of course, 2000, 2001, 2002 was an exception to it. But remember, prior to these 3 years being down, this was the dot-com bubble. You had PE ratios of companies that were, above, well above averages. We saw PE ratios, reach all kinds of crazy numbers. But at one point, we reached on the average 200%. And so there's a big correction with that, okay? Last year we were down, had a really bad market last year, even though we had great economic data, which I'll unpack a little bit. Remember, so far for the year, the S&P is still up 5.64%. So, and again, that's as of the close of business today, April 26th. Again, bond market graph, and again, the aggregate bond index thus far for the year up close to 3%, okay? You have all seen this chart. I love this chart. What you're looking at here is the Consumer Sentiment Index. Every single month, the University of Michigan goes out there and they interview 5,000 households. They ask questions like, we are interested in how people are getting along financially these days. Would you say you and your family living there are better off or worse off financially than you were a year ago? Looking ahead, do you think a year from now, you and your family living there will be better off financially or worse off financially, or just about the same? And what they come up with is they come up with the score. The average since 1971 on that score has been about 86, as you can see on my graph. Now, the blue dots are indicating high readings, in other words, readings well above the average of the Consumer Price Index, and the blue dots below the mean line are showing you when readings came in well below the average of 85. You also notice some numbers underneath there, like a positive 22 or a positive 29 or a positive 1.2. What those numbers represent is what the S&P 500 did for the next 12 months. What I mean by that, if I go back, so it's easy on the eye, to February of 1975, we had a very low consumer confidence reading. Let's call that about a 58, right? Well below the average of 85. However, the S&P 500 from February of 1975 to February of 1976 produced a 22% rate of return. If you notice, let's just look at these return numbers: 22, 20, 29, 32, 14, 22, 15, 43. Very good numbers. Bizarre that they got their answers back from folks saying, no, I won't be better off financially. Let me draw your eye to the same data above the average. And you'll notice, look, August 1972, very high reading. We'll call that a 98 of the consumer confidence. However, the S&P performed from August 1972 to August 1973, a negative 6%. That's not always the case, but you can see how it performed. By the way, December 2022, we had a very low consumer confidence reading. In fact, one of the lowest since 1971. Obviously, we don't know what the S&P 500 will have done from December 22 to December 23, but it's kind of interesting. If I show you this graph, simply what you're looking at is where the consumer confidence numbers came in every single month, okay, from May of 22 until our latest reading here in April of the 63. You can also see that depicted on the graph here. I circled in red the December 22 reading, and you can see it going up. So, why is this? Listen, last year, why did the market sell off, and why is the market why is the market now performing pretty well? We kind of have weaker economic data. You know, we had some bank failures, we've had some layoffs being announced, so on and so forth. Well, think about it. You know, January of 2022, inflation was at 7.5. And when I say inflation, I'm talking about headline inflation. Headline inflation includes all the baskets of goods. There's what's also called core inflation. Core inflation strips out food and energy because the Fed looks at that like it's too volatile. However, we look at headline inflation because it affects the consumer. At the end of the day, the consumer is key to everything. You and I going out there and spending a dollar. Why is the consumer key to everything? Because companies that trade on the stock market are all out there selling a widget. And if that company sells more widgets, they have more profits, right? And their stock price goes up, the company becomes more valuable. Well, as you can see, we started 2022, 7.5% inflation. By the way, we were picking up through 2021. We had comments from the Fed saying, hey, inflation's transitory, nothing to worry about, blah, 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 just to see us come to June and hit the highest inflation number that we had since the 70s at a 9.1. Market was behaving very poorly to this. At the same time, the Federal Reserve was raising interest rates. Why the market was behaving poorly to this is quite simple. If you have inflation going up, okay, and at the same time the Fed raising, the federal funds rate, it goes back to the consumer. If the consumer's spending more at the pump, spending more at the grocery store, spending more to maintain their credit card bill, they're not going to have as much money in their pocket to go and buy widgets. Therefore, companies shouldn't make as much money, and therefore their stock price should go down. If you think about some of the first slides that I showed you, technology, consumer discretionary, the extra dollars, like I said, Amazon's in consumer discretionary. And communication services, Netflix, Google, Facebook, so on and so forth. Those hardest three areas of the market that were hit. Why? Because it's very simple for you to turn off your Netflix subscription. It's very simple for you to cancel your Netflix subscription. It's very simple for you to drop a level maybe in your cellular phone plan, so on and so forth. Those areas got hit the hardest because that's where people would trim from, right? Well, June came along and we started to see inflation falling. In fact, if you go back and you look at some of our videos when we've done these quarterly and we hit these high marks, we said we expect inflation to come down. Well, of course we did, right? There's an old saying in Wall Street, you never fight the Fed. The Fed's fighting inflation, right? You would have to think inflation was coming down. There was a whole bunch of other reasons why we thought inflation was coming down, and I'll show you where those trends are as we continue to work through tonight. If I take that same graph that I just showed you, and I now take it from January of 2022 until our last reading of inflation, this is what it looks like. And so the annual inflation rate in the US slowed for the 9th consecutive period to 5%. This is March's number. It's the lowest that we've seen since May of 2021. We continue down this trend of lowering inflation. And again, we'll pack out why. By the way, the next reading of inflation is on May 10th. That's when we'll get our next inflationary number. There's a little bit of a forecast that we may see that 5% headline inflation tick up a little bit to about 5.2. I think that we'll actually see it remain at either 5 or drop to about 4.9. I'll unpack why I said that, although the general consensus is that it'll pick up a little bit. This is a heat map. So what in the world do I mean this is a heat map? Well, if you look at inflation, you look at the areas that it comes from. The areas are energy, food, core goods, which include vehicles, and core services, which include shelter, okay? Well, energy, to start up here, year over year, March to March, energy down close to 6.4% if you bleed all the energy inside of it. If you look at fuel, the price at the pump for diesel fuel, I'll show you a slide on that in a moment, but diesel fuel actually down 17%. Used car prices, the biggest component of core goods, used car prices are down year over year, 11.6%, 11.6%. That's March of 2022 to March of 2023. Now, shelter on the other hand, is higher. The cost of shelter includes rent and real estate and so on and so forth. From March of 2022 to March of 2023, shelter prices are actually up about 8%. Now, let's unpack that a little bit, because a lot of people may say to me, hey, listen, what do you mean, Derek? I looked on Zillow, the price of my house is down. Well, let's talk about rent, okay? Imagine this, and I've heard this. I have clients that have vacation apartments, if you will, that they rent and then Airbnb them down in Florida, but all of a sudden their lease comes up a year later, blah, 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 blah. Through 2021, landlords were taking rents and increasing them amazingly. You had somebody who was paying $2,000 a month in rent. All of a sudden it came due. It's June, July, August 2022. They went to go redo their lease. Landlord was saying to them, hey, it's $2,800. Huge jumps inside of that. Some people maybe said, hey, I'm not going to do that. I'm going to move out. But there's a lot of people that re-sign that lease, $2,800, right? They were just paying $2,000, a month before. Because they signed the year lease, it takes an entire year. It's going to be all the way out until August of 23 until that falls off the books. Now that tide turned extremely quickly as we got into the latter part of 2022. And that trend has continued until today. In fact, people that maybe signed 6 months lease, right? Maybe they were paying $2,000, now they're paying $2,800, but they only did it for a 6-month lease. They're all of a sudden now walking back in, say 6 months later, and finding that they're right back to where they started. They're back to $2,000. Why? Because a lot of people moved out of the building and things have become a lot different. So we expect to see that shelter area of inflation. You can see here it's red. Why? Because it continues to increase. You can see here, right, with the used cars, it's green. Why? Because it continues to come down. You can see energy, right, in the green yellow area, right? Why? Because it continues to come down. But shelter's still in red. Takes longer for it to fall off. But when I talk to clients all day long, who are in rentals and these types of things, this is obviously what I hear. And so that trend of inflation coming down, we expect to see continue. We'll unpack that a little bit more. I said something earlier that maybe is a bit controversial, and that was prices at the pump going down. I have people that disagree with me. And I say, well, my friend, unlike you, we track this every Friday. So every single Friday, what we do is we have a spreadsheet and we track where the prices are. And what you're looking at here is a snip from my spreadsheet. This comes from AAA. It's showing you today, a year ago, where the price for regular, mid-grade, premium, and diesel were. Obviously, there's different areas around the country, so this is averaging it out, and where they are today. And as I said earlier, diesel fuel, I guess this isn't as of today, this was as of Friday last week, diesel fuel down 17%, regular gasoline down 11%, mid-grade and premium also down nearly close to double digits. That all said, inflation is something that's going on globally. So globally, we see inflation at 6.1. If you look at the developed countries throughout the world, such as, the US, Canada, Japan, so on and so forth, you can see high inflationary numbers. Emerging market countries that typically have higher inflation, you can see in China, inflation only at 1%. Of course, China's been on lockdown and COVID. Again, we see in the inflation forecast, we see inflation continuously going down. I'll show you some more slides to support that. Let's talk about the consumer. Okay, let's talk about the consumer and start to tie some of this data together. The first thing is the labor market. The labor market remains amazingly strong. As I mentioned earlier, the Federal Reserve has a dual mandate, and one of those things inside of the dual mandate is to keep unemployment at 4%. You may ask, Derek, why 4%? Why not have unemployment at 0%? Here is why. Say you and I own a company, we start a company together, we go out there, we want to hire our first employee, we want to hire a tech person. We put an ad out there to hire a tech person at 60 grand a year. We get no applicants. Why? Unemployment's at 0. Okay, so now we raise it to 80 grand a year, 100 grand a year, 120 grand a year, 150 grand a year. As we raise what that salary is potentially being, we maybe get some applicants, but there's not a free flowing workforce. The Federal Reserve finds that 4% is that not too hot, not too cold, in other words, Goldilocks scenario. Not only does it allow for businesses to operate fluently and effectively, it also helps tame inflation. Today, what we see is we see an engineer leaving a company like, say, Exxon. The engineer is making 150 grand a year, and he can move his desk from building A to building B, and all of a sudden he's making 175 grand. Why? Because the labor market is so tight, companies are forced to pay higher salaries to maybe attract employment. And of course, that is somewhat inflationary. Again, the Fed sees the Goldilocks scenario at inflation, at unemployment at 4. And you can see that the unemployment rate has been holding super steady. In fact, we came down for our last reading in March. We came down in unemployment. Wrong direction. The Fed wants to see that go up. Another reason for the Fed raising the federal funds rate. We'll talk a little bit more about that as we go. Wage growth. Because of the labor market being tight, as I mentioned earlier, if we own that company putting out higher salary, if we're ExxonMobil and we're looking for a new engineer and we're trying to hire maybe from a competitor and we're paying higher, you can see what wage growth has been. So our last reading on wage growth, 7.3%. In other words, from February of 2022 to February of 2023, your average American worker out there received a 7.3% increase in their pay. So now let's put these two things together. You had headline inflation, our last reading of headline inflation at 5%. As I showed you earlier, there's that headline inflation at 5. Our last reading on wage growth at 7.28, rounded up a little bit. However, the consumer year over year, okay, has received effectively a 2.2% increase in their pay. By the way, look at these wage growth numbers if you can still see them on your screen. Compare them to that inflation number. What we did every single quarter in showing you, okay, where the inflation rate was and where the wage growth was, the wage growth was always beating inflation, yet the market was down 20%. Again, the reason why the market was down 20% is because the market's a forward-looking indicator, and the market was going, oh my goodness, inflation's too high, people aren't going to buy as many widgets, and at the same time, the Federal Reserve is making money more expensive. People will not buy as many widgets, sell Facebook, sell Google, sell Apple, right? As I showed you earlier. However, what really happened, and this is the data through 22 into 23, is the consumer looked at that inflation and they spent more money. The consumer's been amazingly resilient. The consumer's been spending money like a drunken sailor. In fact, if you look at the fourth quarter of 2022, consumer spending in the United States increased by about 14.2 billion in the fourth quarter. Okay, we are seeing things flatten out, but the market was down so much in 2022 because market's a forward-looking indicator. The consumer should stop spending. However, with the wage growth where it was, okay, the consumer continued to spend. Now we are seeing things flatten out, and there's a reason for that. The reason for that is job layoffs and discharges. Now, what I mean by job layoffs and discharges is we're seeing that pick up, a little bit, right? You've seen in the headlines, hey, we have some layoffs. A lot of the layoffs are inside of the tech sector. We've seen some of the consulting firms, I believe Ernst & Young came out and laying off 7 to 10% of their workforce. Facebook announced laying off another 7 to 10% of their workforce. Listen, when the Federal Reserve raises interest rates, they intend to create cracks in the economy. When the Federal Reserve raises interest rates, they intend to have unemployment go up, again, to hedge inflation. But listen, the number of layoffs in the United States increased by 215,000 jobs to 1.5 million in February. The rate is a little changed. It only represents about 1%, okay? But as this federal funds rate stays high, and what we believe is the Fed will continue to raise, assuming that we don't get unemployment to go to 4. Listen, 3.5 to 4 is not a huge change in the number, but it's a pretty darn big change in the number of unemployed people. Okay. Also, at the same time, hiring plans and announcements. So listen, companies were hiring like crazy up until the end of 2022. And what you see here is right here, this tapering off. So as companies don't say, hey, listen, we're looking to hire, we're looking to hire, although it's still pretty hot, as that continuously comes down. And listen, it is coming down, okay? That wage growth won't be as high. Well, Derek, if that wage growth's not as high, is inflation still going to be around? So we'll keep working on that. I don't know what happened here. I don't know why that's green. It may have been how I saved it. I was working on this on a cloud-based system right before I saved in the presentation, but this is the same slide I showed you a moment ago. It was simply headline inflation showing you our last reading at 5, wage growth at 7.2 in the year over year. I show you the federal funds rate again. And earlier I said to you, listen, in 2022, the Federal Reserve took rates from 0.5, okay, until where we ended the year at 4.5%. It was an 800% increase. But if you really look at it, this is a 12-month. We went from 0.5 to 5%. That's where we sit today, okay? That is really a 900% increase, okay? That's really a 900% increase. And so I wanted to look a little bit deeper at the consumer. I wanted to know what was going on with their wallet. I wanted to know, listen, are they going to stop spending? Okay. Well, a few interesting things. The first thing is if we look at it from 1960 until basically current date, the average savings rate, what an average American worker saves, is about 9% of their pay. Okay. You can see the gray bars. As you see today, we're well below the average. Why has that shrank? Why is the consumer saving less? Well, if we look at revolving consumer credit outstanding, it's picked way up, okay? What does that mean? That means credit card balances have increased, okay? Credit card balances have increased, as you can see with both of the charts. In fact, if we look at this next chart, what this is showing us is that credit cards in the United States increased to 564 million in the fourth quarter from 553 million in the third quarter, okay, of 2022. Obviously, we don't have first quarter 2023 results. Why is this? Why are credit card balances increasing? Okay. Well, credit card balances are increasing for many reasons, but one of the main reasons is where the federal funds rate is. If you think about it, say you take somebody who had $25,000 of credit card debt, and I know credit card debt, is tremendously expensive. Let's say they were paying 18% on it. So that person was making, whatever, $500 payments to just maintain that credit card balance. All of a sudden, the Federal Reserve raises interest rates by 900% over a 12-month period of time from 0.50 to where we are today at 5%. Well, what happens at that 18% on the credit card? It increases. Now it's at 28%. So what's that person do? They stop saving. That's why we're well below average, okay? And what also happens is their credit card balance jumps up. Because of that, we are starting to see little credit card non-payments. We're also starting to see some used car or car payments. Also, with that whole federal funds rate, when I said money becomes more expensive, if you think about it, we've kind of been living in bliss over the last 15, 20 years at a low, very low federal funds rate. Let's say you take a professional who started leasing a car 15 years ago, paying whatever, $300 a month to lease a car. And every 2, 3 years the lease comes up. They walk into the dealership. Hey, I'm here to redo my lease. The dealership said, oh yeah, you used to pay 300. Now it's 325 bucks. It didn't go up too much. All of a sudden, that person this summer, or let's say next week, that 2-year lease comes up. This person now, because they've been doing it 15, 20 years, started paying 300. Maybe today they're paying like 450, whatever, for the car. They've been leasing, let's say, a BMW for 15, 20 years. They walk back in next week, and because of where the federal funds rate and then where the bank lending rates are, because remember, the bank lending rate it's the difference, right? The Fed's at 5, bank lending rates at 7.82. That also affects leases on cars. That person walks back in, yeah, it's gone up a little bit, just a few dollars, every time I redo the lease, maybe 25 bucks, no big deal. They walk in today and say, sir, you used to pay $425 a month for the car, $450 for the month. You want to release the same car. I get it's a newer year, but because of where the federal funds rate is, that the dealership doesn't say that to them, but listen, your new payment's $725, a dramatic jump. Well, think about it. Isn't that going to take more money out of the consumer's pocket so that they don't have as much to spend in widgets? And that leads me to corporate profits. If we look at corporate profits, right, even though the market was so far off in 2022, again, the S&P down 20%, think about it. The economic data was actually pretty darn good. Yeah, you had inflation going up, but wage growth was beating it. Yeah, you had the Fed raising interest rates, and that was going to cause the consumer to even get weaker. But as I showed you with the consumer spending numbers, the consumer was spending and spending, and of course they could, right, because they were getting that wage growth. But that said, you would expect corporate profits to come down as these things start to affect the consumer. Oh my God, Derek, does that mean that the market's is going to do really poorly? Again, I say the market is a forward-looking indicator. So why is the market doing well today if we expect corporate profits to perhaps go down? Here is why. Again, it's a forward indicator. The market's already sold off. The S&P already sold off 20% in 2022. Here we are today, 2023. We have the Fed meeting on May 10th. The market, we believe, is a little bit over its skis. In other words, listen, the Fed's going to raise 25 basis points. That's baked into the market today. But we also expect the Fed to say, hey, listen, we're going to be data dependent. We're probably not going to be raising rates as aggressively as we have. We agree they won't be raising rates as aggressively, but we don't necessarily believe they're going to have a 25 basis point raise and then done. I think Powell will come out of the meeting. They will raise rates by 25 basis points. He won't make the comments that the markets are looking for today. He still wants to remain tough on inflation. There's no place there that near their mandate. Unemployment is, at 3.5. It ticked down last reading. Headline inflation, is still well above their 2%. Headline inflation still, headline inflation is at 5. Core inflation is more like 4.2, but it's still more than double their mandate. And so, listen, the Fed, I don't think he's going to come out and necessarily say they're going to be data dependent. But then why is the market up? The market's a forward-looking indicator. So what do I mean by that? We've all heard the Fed talk about this soft landing. And for those of you who've joined these webinars in the past, you've heard me say this. The Fed's going to get a soft landing. Why? Because today they got the federal funds rate at 5%, and they're going to raise to 5.25. Well, if this market, or if we enter into recession, what's the Fed going to do? The Fed's going to cut rates, no different than I showed you in previous slides. When they cut rates, think of the spur of economic activity. Everything that I've been mentioning reverses. In other words, that credit card rate that's now at 27% goes back down to 18. all of a sudden that person who got hit with that higher car payment, right? Whatever I said, 725, 625, that used to paying 425. Listen, they're now 6 months into the lease. They did a 2-year lease. They walk back in the dealership. They find themselves releasing the same new car though, but their payment's gone down. You see everybody who's purchased a home over the last 6 months go and refinance that home. In other words, in all of those scenarios, unlike what the market believed was going to happen through 2022, it's the complete reverse. All of a sudden, the consumer has more money in their pocket to do what? To purchase more widgets. The market's just a bit ahead of both of these scenarios. It's a little bit squirrely. Okay, this is why the market, right? The market's up now because, listen, the Fed's not going to be as aggressive. Even if they raise 25 basis points and he doesn't come out and say, hey, we're going to be data dependent, the expectation is that they will. And why is that? So the question of recession, if we go and look at recession, recessions have been caused by one of three things or a combination of the three things, as again, you who have joined the seminars before know. Those three things include commodity spikes, an aggressive Fed, and extreme valuations. So listen, let's look at commodities real quick. Where are we at with commodities? If you go back and look at some of the old videos that we did, I showed you all these graphs and talked about these different areas, the commodity market, right? The first being energy. We said, hey, listen, we believe energy will come down. We believe the price of energy is someplace between 70 and 80. Well, if we look at crude oil year over year, from April 26th of 2022 to April 26th of 2023, crude oil is down 26%. Brent is down 25%. Natural gas down 70%. Remember, natural gas was up like 125, Ukraine, Russia. Gasoline down 23. Look at the list. Everything in the energy sector, that's year over year, down big numbers, okay? If I flip that and I look at metals, why metals? Metals go into a lot of building, a lot of construction. They also go into cars. They also go into circuit boards and so on and so forth, and a lot of other things. Look at where metals are. Let's remove gold and silver. You can see gold and silver year over year are up. The reason why I'm removing gold and silver is, although gold and silver are used in those areas, gold and silver gets prompted up when people believe, there's going to be a big tumble in the market. If I go and look at things like copper, steel, iron, right? Look at that. Copper down 14%, steel down 28%, iron down 22%, lithium down 64%, titanium down 50%, HRC steel down 30%. When I say these things are down, these are all positive things for inflation, right? When I showed you energy, that's less money people are spending at the pump, less money companies are spending to transport product. When I show you copper, steel, iron, so on and so forth, making construction product cheaper, therefore perhaps making housing cheaper or labor cost cheaper. If I then flip and I go to agriculture, I have a lot of things on tonight's graph. You see things in there, even like milk, okay? But let me go and highlight the big four that I like to look at. Lumber, obviously a big one. It's down 66% year over year. I showed you guys different charts in previous webinars when we saw lumber. I remember talking to clients in the construction business saying to me, geez, Derek, I used to buy a piece of particle board for $10. I just paid, $110 for a piece of particle board. All back down. Cotton, right? Price of clothes. You remember that in one of those inflationary areas, cotton down 45%. At one point last year, I think it was first quarter, second quarter webinar, I showed you cotton up like 130%. Wheat down 45%. I bring up wheat because look at the labels of the food you eat. There's wheat in almost all of it. Not if it's fruits and vegetables, but you catch my drift, right? And corn. Corn and all different types of things, and all of these areas down hugely year over year. So do we have a spike in commodities? No, we continuously see commodities coming down. Do we have extreme valuations? So every Friday, the Wall Street Journal publishes what the PE ratios are, both what they were historically over the last 12 months and what they are based upon stock prices as of the close of business on Friday for the 12 months looking forward. And so, the Dow, if you look at the Dow, you can see that the Dow Jones Industrial Average has a PE ratio. This is again as of April 24th. So this is, this was Monday, April 24th, and then down here you see Friday the 21st, and the Russell, NASDAQ, and S&P are every Friday, and then the Dow's on Monday. But what you can see here is the Dow has a P ratio of 22.7. What is a P ratio? I'll explain in a second. Why is it important? I'll explain that in a second. If we jump down here and we look at Friday's close of the market, look at the S&P, 18.62 PE ratio. Now listen, a year ago, the PE of the S&P was at 24. A year ago, the PE ratio of the Dow Jones Industrial was at 19. Why is this important? I'm going to skip this slide because I don't like it. I'm going to show you this slide. What this is showing you is where PE ratios were since 2013. So it's a 10-year average. What you'll notice here is the blue line is showing you the trailing 12-month PE ratio over a 10-year period of time. And what the green line is showing you is what the 5-year trailing P ratio has been, okay? And so you can see where P ratios are today. P ratio is simply this, price to earnings. You've all heard me explain it with the ice cream store analogy, so on and so forth. But here's what I mean. For those of you who are familiar with P, sorry, I digress, but let me just explain it in 2 seconds. How do you know what a stock is supposed to be worth? Well, I'm looking across the room here and I see Shark Tank on. And for those of you who are a fan of Shark Tank, I always kind of giggle when I listen to it because they'll, ask about the company and all that. And then somebody will say, and it's typically Mr. Wonderful, will say, tell me about your earnings. And if a company says, oh, we don't have any earnings, or oh, we earn this much and that much, you see everybody look down at their pad and quickly do this math. So a PE ratio is price divided by earnings. Closely held companies typically get for a sale price of their company 3 to 5 times earnings. In other words, you own a company that isn't publicly traded, you make $1 million a year, you got 900 grand of expenses, therefore you're left with $100,000 of revenue. If you went to go sell that company, typically you would get 3 to 5 times. In other words, somebody will write you a check for 300 to 500 grand for your company, for the right to ring the register for the next 30 years. Publicly traded companies, on the other hand, if you go back to 1926, typically get a PE of about 16.5 times earnings. In other words, same scenario, 100 grand in revenue, okay? If you were to be public, all of a sudden, the company's worth about 1,650,000 on average, okay? But again, that's going back to 1926. A lot's changed, right? I'm showing you a 10-year average here now. You can see here, if I look at that 10-year average on the blue line, P ratios, have been a bit higher. Let's call it at about 21. Today we're at 18. So in other words, we don't have extreme valuations back, after the dot-com bubble. I mentioned this earlier in tonight's presentation on the NASDAQ 100, we hit a P ratio of 200, okay? By the way, real quick, if those of you scratching your head going, why do publicly traded companies get a larger valuation than a privately held company? It's what's called the liquidity premium. There's about a 12% liquidity premium. In other words, if you own an ice cream store privately, you own it yourself, and tonight an article comes out that ice cream causes cancer. All of a sudden, the line outside of your ice cream store is going to dry up. There's not going to be as many people buying ice cream from you, if anyone. If you own stock in Haagen-Dazs and it's publicly traded, with the click of a button, you're no longer in the ice cream business. Therefore, that is why publicly traded companies get a 12% premium on PE. Point is in all of that, me saying all of that, is although a little frothy based upon, a 120-year average, as you can see here, we're kind of right in line. We're a little higher, but, we're kind of right in line with where P ratios are supposed to be, okay? So we don't have huge P ratios. And then the last thing is the aggressive Fed, and then I'll wrap this up. So, listen, Is the Fed being too aggressive? And what I'd like to say is I think that Powell, although, listen, with the Federal Reserve raising rates the way that they have, you've seen them put cracks in the economy. By the way, with the Fed raising rates the way that they have, that's why you are seeing all this bank turmoil. Banks, with their reserves, generally hold treasuries, right, and very short-term debt. When you have debt, as I explained with the bond market, and the Fed raises by 900%, the price of that bond that you have on your books goes down. And when that goes down on your books, it looks like, oh my goodness, like if we had a run on the bank, we can't meet deposits. And so, yeah, they cause cracks in the economy as far as with the banks and everything else. But if you look at it, the Fed's kind of done a great job. Think about it. You had inflation running here, wage growth that was beating inflation at a pretty nice pace, 1, 2, 1, 2 to 3%, in each one of the readings. The Fed was able to raise the federal fund rate. I will tell you this, the scary thing for me is when they brought it to 0.25. I remember March 15th of 2020. I was sitting in the office and they cut it to 0.25. And I thought to myself, they don't have any bullets left in the gun. I guess they had one bullet. They could have cut it by, another 25 basis points, but I shouldn't say it can't go below zero. Japan did that. Japan went to a negative interest rate. In other words, you put 100 grand in the bank January 1st, you came back December 31st, and your 100 grand in the bank is now only worth 98,000. Why did they do that? They said, hey, listen, take your money out of the bank and go do something with it, spend it. It's going to do nothing but lose money here. But prior to Japan doing that, I said, hey, listen, you can't go below zero. The Federal Reserve, through all this, has been able to reload their gun, and they're going to put another bullet in their gun in May when they raise 25 basis points, I believe. Listen, a lot of things can happen between now and the Fed meeting, but as things stand today, I think they will raise 25 basis points. When I say that the Fed has done a masterful job, listen, they've been able to reload the gun. They're taming inflation slowly but surely. We are seeing all of those commodities that I showed you earlier come down. So you may ask, Derek, why would you say that you don't think that the Fed's going to give the language of, hey, listen, we're going to be data dependent? I think they're not going to give that language at the May meeting. However, I do think it's coming down the road. I do think it's coming down the road. I just don't think that Powell is going to do that 180. I think that he's going to come out there. He's going to say, listen, our federal funds policy of raising rates the way that we have has performed wonderfully. And we're going to continue to do our job. Thank you very much. And he's not going to say, what I don't think he's going to say is, listen, we're going to be data dependent. We're done with our rising interest rates, but I think we get there. And I think we get there mid to latter part of the summer, where we have the Fed come out and start to say stuff like that, especially if we see those areas continue with where they are. Energy, by the way, food prices at the grocery store, I understand, are still up a bit. We'll start to see those come down. But I think, this inflationary pressure is relieving itself. We'll also see wage growth go down. So we'll be interested to see where that spread is. But the labor market's so big. And, I think we'll get a nice spread inside of that. Again, these are reasons why the market's behaving pretty nicely through 2023. The market is expecting exactly as I said. And what the market's also expecting is, listen, we talk about recession. I think that we probably will technically go into recession. In other words, we'll have 2 quarters of negative GDP growth. Now, listen, I don't know, 6 months ago or something, Washington changed the definition of recession. But when they changed the definition of recession, they put no gauge on it. So I'm going to use the definition of recession that's been around since, I don't know, the 1700s or something like that, and it's 2 quarters of negative GDP growth. I think that we might do that, or we might bump very close to doing that. I think that with the Fed reloading their gun, if the Fed sees things cooling very quickly, no different than we saw things happen very rapidly, they will start to cut interest rates. When they start to cut interest rates, that bond market, why is the bond market up if interest rates are going to go up, Derek, in May? Bond market already has that baked in, that interest rates are going to go up in May. The bond market is also expecting, exactly as I discussed here today, for interest rates eventually to get cut, When those rates get cut, the price of bonds go up, which is why bonds are up today. Markets, the stock market, the bond market is a forward-looking indicator. I think we're going to have a mixed bag of goods as we get into, the spring and summer months. Companies are doing pretty darn well with their earnings. We have companies out there reporting earnings. Something like 76% of companies have beaten expectations. However, a lot of companies are giving that negative guidance. Hey, we don't expect to sell as many widgets next quarter. Why? Because of the data I shared with you tonight. Companies are also out there saying, listen, we're not going to be hiring as many people. They're giving that type of guidance. I like to say this to you. A lot of what I said here tonight isn't necessarily my opinion. I'm just reporting the news. Of course, when I have a lot of people on a webinar tonight, people want to bring up politics, people want to bring up Russia, people want to bring up the Ukraine, people want to bring up China. I get all of that, and I understand all of that. What I'm doing is I'm just boiling it down to its core. Here's what's happened. Why did that happen? There's facts, and then there's debating topics, right? But a lot of what I showed you tonight are the facts. Point being is nobody can really necessarily predict the market, but if you think about it, it's quite strange. 2022 really didn't have bad economic data. In fact, we had good economic data. 2023, listen, we're just through the first quarter. The economic data is pretty good, but it's not as good as it was in 22. Yet the market's up. Nasdaq's up 17, 19%. I think we'll kind of trade in a range. We'll do that between now and the end of the summer. Of course, we'll have things that happen, such as this little banking failures that we had, so on and so forth. We'll have little news things, but I think if we look at where the market is today and where we get to towards the end of the summer, we'll kind of end up right around the same place. We might have some wild swings between there, but we end up in the same place. I think as we get towards the end of the summer and into the fall and winter months, some of this inflation, people, if everyone want to talk about inflation the last 12 months, it'll be, old news. Inflation will basically be out of the window. We will see unemployment getting closer to 4, getting closer to 4, getting closer to 4, and we'll see what the Fed does. Now, the Fed might never, when I say never cut rates, eventually they'll cut rates, but the Fed might not cut rates. That doesn't mean that the markets can't do well. It'll just be kind of a new evening point. I do think that, things tend to get underdone and overdone. So I wouldn't be surprised if we start to see the Federal Reserve cut the federal funds rate towards the end of 2023 and in the beginning of 2024. By the way, don't take my word for that. If you go to the Federal Reserve's website and you look at where they project their federal funds rate going, that's what they project. And I laugh about that because I go, why would the Fed cut rates? And there's one reason. We enter into a recession, that's why they cut rates, or we just have such a slowing economy. But of course, the market does well staring that in the face because it's a forward-looking indicator. It is anticipating the Fed cutting rates. Listen, I hope I tied the information together for you. For those of you on the webinar this evening, you know that I have some family members that in ICU, and so I apologize if I was a little scatterbrained tonight and so on and so forth. But as you can see, the data was put together. The staff here was very nice to throw that data together for me right after 2 o'clock today. So I had an updated presentation. Listen, what we do is we help our clients analyze their situation. We help on the investment side of things. We put together realistic expectations and performance. We monitor, recommend changes to the portfolio over time. We educate our clients. I hope tonight, even though I'm a bit scatterbrained with what I got going on, I hope that tonight I did take a lot of the financial information that was out there and tried to put it into bite-sized pieces and wrap it up for all of you. If you don't know who we are, you can go to our website at triumphcapitalmanagement.com. While you're there, you can schedule an appointment. If you'd like to schedule with myself directly, you can go, there's an About Us tab. You can find me. I have a scheduling link there. And at the top, there's also a scheduling link. And if you click on the one at the top, you may end up on my calendar. You'll see whose calendar to get on. But if you want to schedule with any particular person, go to their profile and you can schedule with them. In addition to that, if you'd like the slides for tonight's presentation, we're more than happy to send them to you. Typically, after I do this, as you notice, one slide was messed up, something was all in green. We'll go back and fix that. I'm scheduled to jump on a plane first thing in the morning. I'll probably fix that at some point over the weekend. So if you would like the slides and you want to request them, you can certainly send an email either to myself. You see my email address down here. There is the website. You can send an email to info@Triumph Capital Management. You can call the office. You can send a smoke signal. Point being is typically we would send these to you the next day, but if you do request these, we will more than likely send them to you a little bit later, only because I like to go through them before they go out. Lastly, if you are on the call tonight, you could have said, geez, Derek was talking real fast. I want to know what he said. As always, you will receive a recording of tonight's presentation in your inbox at some point over the next 24 hours. The system does it automatically. Thank you all. I know we went over, we always do. Sorry, I can get lengthy. By the way, I feel like I just did all that in 10 minutes. I could talk about each one of those slides for an hour. I thank you all very much. And thank you all for those of you who have sent in your prayers and wishes and everything else. And listen, have a wonderful, wonderful, wonderful evening. For me, I'm signing off. By the way, sorry, I should have mentioned this earlier. If you go to our website, there's an area, I think it's called free webinars or something like that. We have a series of these coming up. The next quarterly one, there's 2 or 3 more that we'll be posting over the next 10 to 15 days. So if you do go, of course, those of you who are on here, you get invites to them and everything else. But if you want to register, and again, we'll be adding a few more by, again, over the next 10, 15 days, you can register there. Anyways, again, thank you all so much. Have a wonderful evening, and thank you. Good night.